Introduction. The State Bank of Pakistan, SBP, operates as the central bank, established under the State Bank of Pakistan Act, 1956. It regulates the monetary and credit system to ensure stability and promote the country's economic growth. The SBP has three subsidiaries: SBP Banking Services Corporation, SBP-BSC, National Institute of Banking and Finance, NIBAF, and Deposit Protection Corporation, DPC. SBP-BSC supports SBP in currency handling, credit management, interbank settlements, and government savings instruments. It also manages public debt, foreign exchange operations, and export finance. NIBAF, the training arm of SBP, offering executive development programs and international courses on banking. It provides training to SBP-BSC and other financial institutions. DPC, a subsidiary responsible for deposit protection, ensuring compensation to depositors in case of a financial institution's failure. Legal framework. SBP's functions are governed by various acts, including the SBP Act, 1956, Banking Companies Ordinance, 1962, Foreign Exchange Regulations Act, 1947, and Payment System and Electronic Fund Transfer Act, 2007. Functions of SBP. Regulation of liquidity. Manages monetary and credit policy to achieve growth and stability, using both direct and indirect instruments of monetary management. Financial system soundness. Regulates and supervises the financial system to ensure stability and protect depositors. Adopts a risk-based supervisory approach. Exchange rate management. Maintains the external value of the currency, regulates foreign exchange reserves, and manages the exchange rate to support competitiveness and stability in the foreign exchange market. Developmental role. Beyond regulatory functions, the SBP plays a developmental role, promoting economic growth by developing monetary and capital markets, assisting economic growth, and directing credit according to development priorities. In summary, the State Bank of Pakistan acts as the central bank, regulating the monetary system, overseeing subsidiaries for specific functions, and playing a crucial role in ensuring financial stability and fostering economic development in the country. Definition and general terms. Bank, a banking company as defined in the Banking Companies Ordinance, 1962. Borrower, an individual receiving consumer financing from a bank/DFI for personal, domestic, or household purposes. Consumer financing, financing provided to individuals for personal use, including credit cards, auto loans, and personal loans. Days past due, the number of days a consumer finance facility is overdue. DFI, development financial institution, including specific entities listed. Equity, the bank/DFI's paid-up capital, reserves, and other financial components. Financial institutions, banks, DFIs, and non-banking finance companies, NBFCs. Financing facilities, loans/advances/financing provided by banks/DFIs. Free credit period, duration during which no interest is charged on credit card transactions. Government securities, Pak rupee obligations guaranteed by the government. Liquid assets, easily convertible assets, including government securities, bank deposits, and listed shares. Negative amortization, minimum payment insufficient to amortize the principal amount. NBFC, non-banking finance company, including various financial entities. Rescheduling, granting concession by extending the grace period without changing terms. Restructuring, granting concessions involving changes in terms, tenor, or rates. Secured, exposure backed by tangible security, clean if without tangible security. Tangible security includes liquid assets, mortgage on land/building, and hypothecation on vehicles. Teaser rate, initial lower interest rate employed for a short period in consumer financing. Minimum requirements for consumer financing. Establish a dedicated risk management capacity. Develop a comprehensive consumer credit policy approved by the board. Establish a product program and an efficient management information system, MIS. Develop recovery procedures for delinquent consumer financing facilities. Become a member of at least one Consumer Credit Information Bureau. Impart ongoing training to staff. Prepare standardized borrowing and recourse documents. Establish a common glossary of terms in coordination with the industry. Operations. Assess and verify borrowers' income through various modes. Obtain a consumer credit report from Credit Information Bureau. Obtain a written declaration on existing finance facilities from the borrower. Provide periodic statements of account to customers. Provide a detailed repayment schedule at the outset. Strengthen internal audit and control functions. Consider feasibility of tiered markup rates or risk-based pricing. Disclosure/ethics. Clearly disclose all terms, conditions, fees, charges, and penalties. Publish brochures answering frequently asked questions for customer guidance. Set a minimum payment due, MPD, to avoid negative amortization. Disclose annualized percentage rate, APR, for transparency in interest rates. Regulations of SBP. Regulation R1. Facilities to related persons and proper utilization of clean financing facilities. Facilities to related persons, consumer finance facilities for directors, major shareholders, employees, and their families must adhere to arm's length principles and normal terms. Appraisal standards should not be compromised, and market rates should be applied. Exception for consumer financing to employees as part of compensation, subject to detailed terms in approved rules. Proper utilization of clean financing facilities. Banks/DFIs should implement checks to prevent misuse of clean financing facilities. Regulation R2. Limit on exposure against total consumer financing. Aggregate exposure under consumer financing should not exceed 2 times equity in the first year and 4 times in the second year. Subsequent limits based on classified consumer financing. Below 3%, 10 times equity. Below 5%, 6 times equity. Below 10%, 4 times equity. 10% and above, 2 times equity. Regulation R3. Total financing facilities to be commensurate with the income. Total monthly amortization payments should not exceed 50% of the net disposable income of the borrower. Spouse's income may be considered with consent and specified conditions. Waiver allowed for 50% debt burden in secured cases with 30% margin or below. Affordability tests and feasibility reports for tiered markup rates in certain cases. Regulation R4. General reserve against consumer finance. Maintain a general reserve based on percentages of secured and unsecured consumer finance portfolio. Regulation R51. Rescheduling/restructuring of performing/non-performing consumer financing facilities. Policy framework for rescheduling/restructuring with approval requirements. Conditions and limitations on rescheduling/restructuring frequency. Provisions handling for rescheduled/restructured non-performing facilities. Regulation R6. Classification and provisioning of receivables. Receivables against non-performing loans, to be classified with 100% provisions. Regulation R7. Margin requirements. Banks/DFIs determine margin requirements based on risk profile. Restrictions on shares/TFCs apply. State bank retains power to set/reinstate margin requirements. Regulation R8. Maximum clean limit for credit card and personal loan/financing. Clean exposure up to 2 million rupees allowed on credit card and personal loan/financing. Aggregate clean limit from all banks/DFIs capped at 5 million rupees. Exemptions for secured credit cards and certain personal financing facilities. Limits on financing against CDNS securities, subject to prescribed limits.